Nigeria has failed to ramp up crude oil production despite the efforts by various agencies of government, apparently producing 558,000 less barrels of oil in April compared with March. The Organization of Petroleum Exporting Countries, OPEC, made this known in its monthly oil market report for May. The Africa Finance Corporation has launched a $2 billion fund to support economic recovery in Africa following the disruption of the COVID-19 and Russia-Ukraine war. Lagos-based AFC has committed to fund up to 50% of the African Economic Resilience Facility and will mobilize the rest through its network of international partners and investors. During the forum, which was held in Abuja and featured former Nigerian President Olusegun Obasanjo and current Vice President Yemi Osibanjo and Nana Akufo-Addo, President of Ghana, a panel discussion on raising capital for infrastructure and Africa's cost of capital was discussed. Let's take a listen.
In order to scale the capital, the investments on the continent, first of all, we all need to strive to bring the cost of the capital down. And the only way, actually, to bring that cost of capital down is by creating more awareness, more partnership, and it's about collaboration, right? Because if the international perception of the risk in the continent is disproportionate to what the actual reality is, the continent, the local borrowers are getting penalized, right? And I will give you a very simple example. It all starts from the sovereigns, from the states. If you look at the average cost of borrowing of the Pan-African sovereigns today, is probably around 12-13% per annum. So, and if you compare that cost to the average cost of borrowing of the developed markets, it's a huge discrepancy, and that discrepancy does not match the actual risk. So, if your sovereigns are borrowing at 12-13%, then what does it imply for your private sector? That needs to be a spread above that. Then what does it imply for your private equity capital and infrastructure capital? A spread even above that. So which corporate, which sustainable business model can sustain 20% or more cost of capital? None of it. None. Right? So unless we fix this issue, you are not going to be able to scale the investments into the continent.
Arise business analyst Chika Mbono joins us to discuss further. Chika, good morning to you. Thank you so much for joining us. This is something you've talked about several times with banking, interest rates. What do you make of that excerpt?
The same amendment?
Yes, the cost of capital.
Cost of capital. You know, I mean, there's some correlation between the pricing of loans and the level of risk. And there's a word he used there, which is called perception. A lot of times, it's perception. When you're far removed from the locality where you're lending, a lot of things that you do are based on perceptions. And so that's why I gave the example. And so the guys in New York financial market, London financial districts, and so on and so forth, are there. What are they doing? Looking at CNN breaking news.
Yes.
And that's how they're going to know what's happening in these African countries, Sub-Saharan Africa, or whatever, where they want to lend. And they are feeling things and seeing things and hearing things and reading things. And all those, pile up, add up on the risk, and then translate to the cost of capital. And at the end of the day, you will find that lending in the Western world, as I said, most of them are the lower single digits, 1%, 2%, 3%. Now, by the time they bundle and layer up the risks on Africa, you find them going to double digits. And that's the example that he gave. And so that's actually the real problem. I'll give you an example. I went for a training program some time ago in Switzerland. And, there were participants from maybe about 20 different countries, including maybe 2 African countries, Nigeria and some other, and in South Africa. And then during the break, the first break,
yes,
the next day, the second day, during the break, I mean, after, first day we introduce ourselves. Some guy who came to me, he was the general manager of General Motors. He was the CEO of General Motors, the whole Europe, was in the class. And he brought out a file for me titled Nigerian 419.
What? So that's the perception that
Yeah.
you're talking about. Wow.
Nigerian 419.
Yeah.
I mean, that's the only thing. General Motors, the CEO for the whole Europe. What he has about Nigeria is what? The 419.
Yeah.
I just brought the file for me and asked me questions. Is this real? Is this what's happening and whatever? So that's how they feel about this. So what are the issues? You know, sanctity of contracts, the issues in the judicial system,
Yeah.
approvals and compliances, you know, multiple taxation for the projects,
Yeah.
and you find that all this layer up
And add to the
and add to the cost.
Yeah.
And someone who's out there is seeing all this, and that's what it's saying. That when they are far away from us, that's the perception. The reality on the ground when they get in here. You know, do you know that a lot of these people in the Western world, when they come into Nigeria, they think that when they land in Motamo Airport or whatever, I mean, things are bad. There's insecurity problem, but they just think that some of them think that monkeys are just walking around, people are naked, and I mean, you'd be surprised the kind of impression they have.
Yeah.
So that's what the gap is trying to fill. Gap is addressing. And how do you feel that? So if they're lending directly to African corporates without any intermediary, that perception will be there. So you can imagine the sovereign, which is the country. If the country is borrowing, the country is supposed to be the best risk in Nigeria.
Right.
The country is borrowing at 12%.
Then what about
What happened to the corporates in Nigeria?
Right.
The corporates inside it.
Yeah.
They must be at 12% plus something, you know. And that's also what is pushing out there. So how do you break this? So lending directly to corporates is a problem, because the sovereign is even very high. So that's where things like the African Finance Corporation, African Development Bank, and African Export and Import Bank stand in the middle between
intermediaries.
between Africa and the Western banks or the Western world. So that these institutions like African Finance Corporation, like is a score rated in risk rating, you know, are cleaned up, nice profile, correct risk rating, and so they can borrow in single digits, and therefore can pass on lower digits to the African corporates.
Yeah.
And that ties in again to what African Corporation IFC's launch. Their 2 billion naira.
What do you think of the fund?
African Resilient Fund.
Yeah.
Important, because you see, who can do it for you? Remember what we're talking about here, that since COVID, every country is being insular. You know,
yeah.
every country looking inwards, trying to solve their own problem. So who will solve African problems? Us. And that's why that fund is very key. So 2 billion naira.
Dollars.
2 billion. $2 billion, please. $2 billion African Resilience Fund.
Yes.
The AFC is going to fund, who just celebrated their 15 years, going to fund half of that and get the other from their network of international partners, and then disperse it through commercial banks, regional development banks, and so on and so forth, to reach the corporates in various jurisdictions. So you find that the whole economy has been battered by COVID. We're trying to survive COVID. Then the Russian war is coming.
Yep.
So that has destroyed the supply chain, trade finance, and so on and so forth. This AFC funding is to assist in providing foreign exchange and liquidity to African corporates and banks to enable them, Africa, to continue to trade and become more resilient and move to recovery.
Arise business analyst Chika Mbono. Chika, thanks for taking us through that
Thanks a lot.
Appreciate it. You're watching the Global Business Report here on Arise News.